Hello everyone, my name is Michael Clough and I work on the investment team here at MGIM. I have the absolute pleasure today of introducing you to Richard Watts from Jupiter Investment Management. Richard co-heads the UK small and mid-cap equity team at Jupiter, and he also manages the Chrysalis Investment Trust. Whilst many investors focus solely on public markets, some of the greatest growth opportunities can be found away from the listed space in private markets. Chrysalis invests primarily in a portfolio of unlisted businesses that are disruptors in their respective industries, often technology-enabled, that helps them to deliver exceptional growth rates that many listed peers struggle to replicate. Richard joined us at Think Tank in 2019, and it's great to have him back this year. So Richard, the virtual floor is all yours.
So thanks, Michael. Hello, everyone. My name is Richard Watts, and I'm the co-manager of Chrysalis Investments. Welcome to investing in the 21st century digital economy. So if I take you back in time to before when we launched Chrysalis, the genesis of our desk is really managing money in the UK mid and small cap listed equity space. We're the largest listed player in the UK mid and small cap market in the UK. We've backed countless IPOs over the years of very innovative, fast-growing, disruptive companies. And we were increasingly realising that some of the most innovative and fast-growing companies that we were coming across were private businesses that were considering their options around an IPO, but ultimately chose to stay private. And we decided and we recognised that the investment landscape was changing, that more companies were staying private, they were staying private longer, and that ultimately, if we didn't do something, that potentially impacted the returns that we could deliver to our clients. So we decided to invest in private companies, and we made our first private investment back in 2017 into a company called TSG, which was then known as the Huck Group. So that was our first private investment. We then followed up very quickly afterwards with an investment in a company called TransferWise, which listed this year and is now called Wise Group. So we describe ourselves as one of the UK's leading crossover investors. And what is a crossover investor? It is someone who invests both privately and publicly and helps those companies transition from the private markets via IPO onto the public markets in time. We have unparalleled insight into the public and private market space given our background. I joined the team at Jupiter back in 2002, or the businesses that became Jupiter in time. So 2002, that's my background with a desk, invested in UK mid and small cap companies. And then obviously more recently, we launched Chrysalis Investments. So unparalleled experience in the space. That gives us a depth of knowledge and sector expertise and experience. And we're able to access some of the most innovative and disruptive companies that we can find, both public and private. And we have global reach, and our ecosystem stretches very broadly, given our history of investing in the UK space and the relationships that we have with investment advisors and others who don't just operate in the UK, but operate across Europe and the world. So we think this is a very significant opportunity here in the private market space to generate outsized returns for our clients. And why? Because these private companies are extremely disruptive, they're extremely innovative, they're very entrepreneurial, and they are very, very fast growing. So just some investment highlights on Chrysalis. So we actually launched Chrysalis in November 2018. So as I said, our first private investment was in 2017. We used our existing funds to make that investment in TSG. And we then felt that we needed a more appropriate ownership vehicle to carry on doing further private investments. And more appropriate, I mean, because these private companies are illiquid, we just needed a permanent capital vehicle. And that's what Chrysalis is. It gives us, permanent capital that we can deploy into companies and not worry about the daily flows of, flows into and out of funds. We've got a very strong track record since launching in November 2018. We've delivered 134% growth in the net asset value per share since our IPO. We've raised a total of £770 million. So the first raise was the IPO of Chrysalis itself, as I said, in November 18, and we raised £100 million. We've done 4 subsequent fundraisers since that point in time, raising a total of £770 million. The net asset value of the company, given the growth in value of the investments that we've made, is now around £1.3 billion. And we are deploying capital very efficiently. The opportunity is simply enormous. The amount of deal flow is absolutely huge. We've made 17 investments since launch. We see 40 to 45 investment opportunities every quarter. So the opportunity to deploy capital is very, very large, but we can be very, very selective. And we're accessing winners, identified world-class assets such as Wise, Klarna, Starling and Wefox ahead of their significant funding rounds. And that's the key for us. We're trying to identify these companies early and capture the value that they subsequently create. And we are now realising returns, which gives substance really to the valuation of Chrysalis itself and the NAV, and it's demonstrating to investors the outsized return potential that exists here. And the two IPOs that we've had in TSG and Wise have been very, very successful for us. We first invested in Wise back in November 2017, and we've made over 8 times our money on that particular investment. And we've just done a recent trade sale of Embark, which is subject to regulatory approval. So we think we're at the forefront of a very significant market opportunity, and the opportunity to continue to develop Chrysalis is simply unparalleled. We're only scratching the surface of the opportunity, and we think substantial potential remains. I think if we step back and try to understand why this opportunity exists, and it simply reflects the fact that private companies have chosen to stay private for longer. We can see the data just for the UK, but we think this applies across the US and Europe too, is that when you measure the average age at exit for a privately financed company, back in 2011, 2012, the average age at exit was around 6 years. Today, that's around 11 years. So companies are staying private for much longer than they have done historically. And if you think about the nature of those companies, very fast growing, very innovative, very disruptive, and that growth is driving an enormous increase in value. So the companies themselves are getting larger. So think businesses like Klarna that just recently announced a funding round valuing the company at over $45 billion. And think about Wise at its recent IPO, where the business is now valued at around £10 billion sterling, so around $14 billion. These companies are creating enormous value and are getting bigger. And therefore the size of the amounts of money and funding rounds that they're doing are getting bigger. And also because companies are staying private for longer, there are more private companies. So the whole private market is growing in size very dramatically. And you can see that on the chart here. If you go back to 2020, the total private fundraising across Europe was around £17 billion sterling. So far this year in 2021, there's over £23 billion. So the market has grown very, very strongly. And yet we are still only a pretty small market share. So our investing is measured in the hundreds of millions of pounds a year. So we're a pretty small market share in a market that is growing very, very strongly. And we don't see why this rate of growth diminishes. The size of the opportunity is huge, the very disruptive nature of the companies, the rate of growth. All of these ingredients add up, we think, to a market that's going to carry on growing very, very strongly. So we think opportunity for us is significant. And we think our crossover proposition is key. And again, just reminding you of what that crossover proposition is. We are able to come onto the share register of a private company and support that company at some point in future through its own IPO process and still be on that shareholder register on the other side. And we think that is providing a very valuable role because we have lots of experience of investing in publicly listed equities, particularly at the point of IPO. So we see ourselves as differentiated capital, and also importantly, we see ourselves as partners where we are partnering with these private companies and helping them grow and build their businesses through time, whether they are private or public. So we think interest in crossover investing is growing, and we have definitive first mover advantage, and we're using that advantage very effectively to identify what we think are some very, very attractive assets that are growing very, very quickly that will hopefully generate lots of value for our shareholders in Chrysalis Investments. So we think we're still in the early stages of developing Chrysalis, and the blurring of the lines between private and public equity continues. So again, just highlighting, the private and public proposition that we have. We see ourselves as sitting in the middle, straddling public and private markets. We are one of the few investors in the UK that is actually doing this, and we're using this proposition now across Europe and increasingly branching further out across the world. So for instance, in the portfolio, we have now 3 US-based investments. Understanding the opportunity, again, for crossover investors is really important. Typical holders of private companies, venture capital, seed investors, angel investors and others, they are natural sellers of equity at the point of IPO. Their funds typically are getting towards the end of their natural lives. These are finite length funds. They have liquidity requirements to return capital back to their investors. So they are natural sellers of equity. Chrysalis Investments is a permanent capital vehicle. We aren't forced sellers of equity. We just see it as part of the journey. An IPO is part of a journey, and we will transition with that company through into the public markets. So if you look at what we do across the wider Jupiter mid and small cap team, we are probably the most active investor in IPOs in the UK. We've supported a number of high-profile IPOs over the years, and so we would see ourselves as natural buyers of equity of private companies at the point of IPO. So again, emphasising that our capital is differentiated and it really is a partnership. So we've committed over £2.5 billion into IPOs as a team over the years, over 20 years of public market experience across the team. As I said, I joined the team in 2002. So we have a lot of relevance, experience, capability, and the opportunity is massive. Looking at how we've got on with Chrysalis, this slide shows the growth in the net asset value of Chrysalis Investments since we launched in November 2018. The first year or so after launch, we kind of describe as the investment phase. The portfolio wasn't fully invested. We started life with 3 seed investments in the portfolio, and then over time we added more investments. So the first year or so we kind of describe as the investment phase. And as the portfolio started to become more fully invested and the rate of growth that our portfolio companies were delivering became more and more apparent, the value of the portfolio, the independent value of the portfolio, started to value those assets higher. And we've also had significant funding rounds. So if you look at Klarna, for instance, it did a funding round in September 2020, another one in March of 2021, and another one in June of this year. So Wise, for instance, has IPO'd, TSG has IPO'd, Starling Bank, Wefox, they've all had funding rounds. So this is real validation from external investors as to the valuations of the equities or the positions within our portfolio. And that's really come through over the last 12 months or so, and you've seen this very, very substantial growth in net asset value per share. So, we've got off to a very, very good start, but we think there's more to come. We measure deal flow. We have excellent origination and sourcing capability. We are seeing 40 to 45 deals typically a quarter. So the rate of deal flow is enormous, and typically, we make anywhere between 3 to 5 investments a year. So just over 1 a quarter, and we see 40 to 45 opportunities. So for us, the opportunity is simply enormous, and we need to be very, very careful in terms of how we deploy capital, because frankly, we can choose to cherry pick the best opportunities that come our way. When we raise money, we can deploy money very, very quickly. So the days taken to be 50 and 75% invested following a fundraise that we've done, typically we can invest 50 to 75% of what we've raised within 3 to 4 months. So again, emphasising that we can deploy capital very quickly, but we will do it in a very careful, judicial way, cherry picking the best opportunities that we see. So we have a very strong pipeline of well-progressed opportunities. We've already completed 8 deals in 2021 and deployed £335 million of capital. We've added 5 new names into the portfolio and completed 3 follow-on investments. The 3 follow-on investments are TSG, Wefox and Starling, and the new positions that we've taken in Chrysalis are Smart Pensions, Revolution Beauty, Deep Instinct, Infosum and Tactus. So again, emphasising our ability to deploy money at scale. These new investments allow us to diversify the portfolio on a sector, geography and thematic basis. And I think for us this is really important. We launched Chrysalis, and in the early days we had 3 investments. And through time we've sourced new opportunities and we've diversified the portfolio. So following the activity in the fund, we have around 15 investments today. And the ambition always was 15 to 20 investments in the portfolio. So we're at the bottom end of that range. But, we are within that range now, and we've done that within, 2.5 years or so of launch. And looking at the portfolio composition, and, we describe this as Wave 1, Wave 2 and Wave 3. And Wave 1 are those rapidly scaling platforms. So those are businesses like Wise, TSG, Klarna, for instance. A wave two we describe as emerging disruptors, so names like Smart Pension, Tactus, and Graphco. Names that are not quite global just yet, but on the path to becoming global businesses. In most cases, they're tech-enabled and therefore have the ability to rapidly scale. But Wise, TSG, Klarna, they're already there. These are already global businesses. They generate hundreds, if not billions of pounds or dollars of revenue. So they are very large companies, but crucially still growing very, very quickly. And then we have Wave 3, which we describe as approaching scale. And names like Deep Instinct and InfoSum, the recent investments that we've made, fit into this category. But other names like FeatureSpace, which provides fraud detection for payment transactions, in very, very large industries, very innovative and very fast growing. So we think it's important to have a nice blend of a portfolio. So we have the larger businesses like the Klarnas of the world that give the portfolio real ballast. And you can see in terms of position size, Klarna is the largest investment that we have in Chrysalis. It's around 25% of the portfolio, followed by large positions in Starling, Wefox and TSG, for instance. So the weight of the portfolio is really anchored towards those later stage private companies. But then behind that, it is important to have the blend, faster growing names that ultimately will be the next Klarna or the next Wise Group. So I think that blend for us is very important. I think other characteristics that I'd highlight here about the fund as well is that most of our companies are very well capitalized. This is not a portfolio full of loss-making investments. Wise is profitable, TSG is profitable, you and Mr. Jones is profitable. So, we have, again, a blend or a balance across the portfolio where it's not a portfolio of loss makers. Many of the businesses are very, very profitable. And if they aren't profitable, they're very well capitalized. So having raised substantial money in recent months in most cases, like Wefox, like Starling, and Klarna, for instance. So a very well capitalized portfolio, and in most cases, very, very profitable. So that means that the liquidity requirements that we have to support these businesses are quite low. So we can focus our efforts on helping these companies build and grow through time and using our capital to find new investments in the portfolio. And our focus really is on building an international high-growth portfolio. So in terms of geographic exposure, you can see our exposure here is pretty broadly spread. The UK is around 29% of sales by destination of the portfolio companies. But that is followed by the rest of Europe at 29%. Good exposure to other geographies like the US and the rest of the world as well. So we think we've built a global portfolio here. This is not just a UK-centric investing vehicle. It's much more diverse and geographically spread than that. If you also look at the rate of growth that the portfolio is offering, and again, it just demonstrates the opportunity in private companies. This is not just specific to Chrysalis. These rates of growth are very, very high across the whole private market space. But if you compare Chrysalis versus the wider UK market and NASDAQ, Chrysalis's revenues, the average rate of revenue growth across the Chrysalis portfolio is just under 80%. NASDAQ was around 20% last year and the all share was negative. So this is a much, much faster growing portfolio of companies. And I would say when you look at valuation as well, and we've given an idea of valuation multiples across the portfolio in presentations that we've made elsewhere. And in many cases, the valuation multiples of our portfolio companies are lower than comparable listed peers. So a portfolio of very fast-growing assets that we think are attractively valued versus listed equity market precedents. So persistence of the level of growth, we think, therefore underpins the ability of Chrysalis to deliver further NAV growth through time because the valuations are attractive. And if they carry on growing very, very quickly, as long as those assets don't derate and the listed market doesn't derate, then that rate of growth will drive, we think, significant value going forward. So look, it's a very well-diversified portfolio, it's a very well-positioned portfolio, but crucially, it's a very, very fast-growing portfolio. And that brings me on to Wefox. When we identified Wefox, people often ask us, what is a typical Chrysalis investment? And what we are looking for is not just tech-enabled investments. What we are actually looking to identify is businesses that are very disruptive in nature and that have the ability to grow very quickly. And I think they all typically share, two characteristics. And one is, utility value. Does the business have a very strong utility value? So is the product or the service that they offer, does that have a lot of value to the customer? And if you think of something like Wise, where the average commission rate on foreign currency exchange is 60 basis points, and that compared to the big banks, exchange rates of 3 to 7%. So the proposition for the customer or the consumer was very, very compelling. Much, much lower transaction costs for changing foreign currency, but also where service and convenience were much better as well. So 35% of transfers typically are done instantaneously, and it's very easy to access your smartphone or your iPad or your app and make a transfer abroad. So they competed on price, they competed on service, and they competed on convenience. So that was a very, very compelling opportunity and proposition to customers. So the utility value of that business was very, very strong. And then, of course, are these companies potentially competing in very large industries or addressable markets? So is the utility value very high, and is the addressable market very, very large? And typically where you find businesses that have those characteristics, those are the businesses that are able to grow very, very quickly, but crucially are able to support that rate of growth for far longer than people imagine and estimate. And that is where we come in. We identify those opportunities that are capable of carrying on growing very, very rapidly. We come in and we think we pay very attractive valuations versus the potential rate of growth that is on offer. And that is why we've identified assets like TransferWise or Wise Group, as it's now called, Klarna, Starling Bank, etc. They've gone on to create a lot of value for Chrysalis. And we met Wefox in late 2019. And Wefox, we think offers very strong utility value. It is very simply using technology to disrupt the insurance industry and market across Europe in terms of lead generation, claims management, back office, operations functionality. It is basically disrupting each and every sector of the insurance market and is passing on the benefits and the cost savings of that to its customers. And so the proposition or the utility value of the business is very, very strong. And obviously the insurance market is simply enormous. So the potential for Wefox to carry on growing very, very strongly exists for year after year after year into the future. And we think it's the market leader in Europe, in terms of insurance technology businesses. So we have the European market leader. And by global comparisons, if you look at US listed peers like Lemonade and Goosehead, Wefox in the last funding round, which valued the business at around $2.5 billion, the last funding round valuation implies that Wefox trades at a substantial discount to listed peers. So we think we have a very fast-growing business disrupting a huge industry that has strong utility value, that trades on a valuation multiple that looks very, very attractive versus listed companies. And that is why we're absolutely delighted to support Julian, Fabian and the rest of the team continue to grow the business going forward. So thank you very much for listening. I hope I've given you a real sense of the opportunity that we have in front of Chrysalis. It's simply enormous, and we think we are very, very well positioned to take advantage of this. But fundamentally, we're enormously excited that we're able to partner with businesses like Wefox and the other investors that we have in the portfolio and help these companies continue to disrupt what are large industries and simply transform people's lives.